Morning, everybody, and welcome to our Know Your Numbers webinar. My name's Steve Richardson. I'm a director at Inspire, and I'll be moderating today. And your presenter is my colleague, fellow director, and all-round good guy, Steve Price. Well, other than the fact he supports the wrong team in Manchester. Yeah, we're really excited about this webinar today. There's a lot of work gone into it, and we're going to make it a little bit interactive with our Mentimeter. Steve will explain that to you later. A little bit of housekeeping. Right at the bottom, you've got your audio settings, so you can you'll be on mute. Certainly, there's a Q&A in the middle, so you can put your questions to the panel there, and at the end of the webinar there'll be some opportunity for us to answer those questions. If you have to leave the meeting at all, then it's the red leave meeting right at the right hand corner of your screen, and you can log back in if need be using your original link. Good. Okay. Steve, good morning. How are you today?
All right. Thank you very much, Steve. Thanks a lot. Thanks for drawing attention to my successful football team. So thank you everybody for taking the time to come on to this morning's webinar. Before I start, I'd like to share a thought with you for the session. So that thought is the budget is not just a collection of numbers, but an expression of our values and our aspirations. So hopefully you've all updated your budgets and forecasts to reflect all the challenges we've got at the moment with the COVID-19 situation. These numbers express your aspirations for the business over the next 12 months. Now it's time to make sure you can understand, monitor and measure what you've set in those budgets and forecasts. This webinar is going to be about demystifying the most common reports you'll be seeing on a weekly, monthly, quarterly, or even annual basis, so that you're in control of your business performance. Okay, so in our webinar this month, we'll cover the importance of knowing your numbers, an overview of the different reports you should be producing, the difference between profit and cash, the key drivers of business value, how to protect your assets, how to adopt best practice. We're then going to outline some potential next steps that you can take to make sure you truly understand your business numbers. So please make sure you take plenty of notes today. Some of what we talk about might sound like a foreign language to you, or what's called accountant's jargon. So send through your questions at any time during the webinar, and as Steve has already said, we're going to cover those at the end. So knowing your numbers is vital. It allows you to interpret your reports and know if you're on track to achieving the goals you've set, whether that's in your business plan or perhaps even at the moment in your business recovery plan. So here are our top 6 reasons why you need to know your numbers. Number 1, they tell the story of your business, allowing you to interpret the results of your business activity. That's plain and simple. Number 2, this helps you identify the symptoms versus the root causes. So as an example, a declining gross profit is a symptom of many root causes, such as, well, it can be a few things: ineffective pricing, perhaps poor purchasing, or too much wastage within the business. Number 3, knowing your numbers will enable you to spot an early warning sign of a potential issue. So for example, monitoring how long it takes customers to pay you allows you to quickly respond if that number starts to increase. Number 4, areas of strengths and weaknesses will be highlighted. So for example, here, your balance sheet indicates whether your business value could be going up or could be going down. Number 5, understanding your numbers also means you have reliable financial information to base your all-important decisions on. Now that's possibly one of the most important of this short list of 6. And then finally, knowledge is power. The more you know about your business, the better your business will be. So I've worked with accountants before who have not been very forthcoming around sharing all the information with their clients, choosing to retain something of a mystique about the information. But we at Inspire believe in empowering you as business owners to adopt an understanding of your own numbers. And of course, that comes with our support behind you. So we're going to do a little bit of audience participation now. If you can reach for your phones or even on your desktop, can you go please to a website? It's menti.com. It's there at the top of the slide, menti.com. And when you get there, it will ask you to enter a code to get to our specific question. And the code I'd like you to enter once you're onto that screen is given here. It's 2829891. When you get to that screen and you enter that number, you should be faced with this question here, as you can see. How do you feel when you come to review your financial reports? And just by way as an example of everybody who's on the webinar today, I'd like you just to put, you know, a 1 or 2 word answer to answer that question. So it's menti.com, MENTI.com. And once you've logged in, it's just putting the quick code in 2829891. If you could put your answers in, we'll have a little bit of a look as to what everybody is saying. So as you can see, some of the answers are coming through now. All right, we've got a few. We've got a few. Overwhelmed, confused, confusion, uninspired, excitement. I'd like to know who that was. Frustrated, scared, curious, undereducated. That's interesting. Daunted, flummoxed. Fantastic word. Apprehension, slightly confused. I think we're picking up on a theme here. Thank you for everybody for participating there. We've had lots of feedback. We're picking up on a theme though, aren't we? And I'll be honest with you, that's exactly why we're running today's seminar. If we're confused, overwhelmed, even undereducated, if we're fearful or scared or even unsure, that is why we need to understand what those numbers are about, because your business numbers are a really important business tool, and we need to try and empower you with the knowledge to know what they're all about so that you can use them. And of course, that comes with the support of your accountant. So let's go back to the presentation and on to the next slide. So let's have a look then how we can this morning, in the next 45 minutes to an hour, try and help you as business owners know your numbers. So an overview of the key reports we're going to go through is to help you understand what you can learn from them. We'll work through an example to show some key learnings and things to look out for in your reports. And throughout this, we're going to use a fictitious company called FoodsCo for all our examples. So just to reiterate, FoodsCo is a fictitious company. So first off, the trading account. Your trading account tracks your sales, variable costs and gross profit to calculate the return you're achieving before you're deducting your fixed overheads costs. So your gross profit percentage indicates whether your margins are perhaps improving or deteriorating. You can track your results across different divisions or product lines by using multiple trading accounts. And for those of you who use a product such as Xero, you'll know how it can use different accounts within the system to do this. So for example, if you work across regional locations, having a trading account for each location will allow you to track and even benchmark how each one of those is performing. Now, small adjustments to the items in your trading account can have a huge impact on your overall results. So let's just have a demonstration of that with some examples. So this is an example, as I've already said, of a food manufacturing company's trading account. And as you can see, they've had sales of just over £1 million, cost of sales of 318,000, and that gives them a gross surplus from trading of just under 700,000. But with their direct costs of 450,000, their gross surplus was ultimately 248,749, as you can see there highlighted in yellow, and that gives a gross profit percentage of 24%. So let's say this company undertakes some effort to change, and let's say they go into coaching with their accountant or business advisor, and they implement strategies to increase their customer retention rate. And this gives them a 10% increase in sales. They also work with their accountant to review their stock processes, and they manage to reduce their cost of sales by 5%. And then they go on to renegotiate their contract, perhaps with their delivery provider, resulting in a 5% saving in their direct costs. So as a result of these three changes, you can see that their gross surplus has now increased by £140,000, and their gross profit percentage has increased from 24 to 35%. So the point we're trying to make here is that understanding your trading account allows you to identify areas where small improvements can have big impacts on the profitability of your business. Now, the trading account is part of, I think most of you will know, it is part of the profit and loss statement. So let's now go on to have a look at the wider profit and loss statement. And this shows all your earnings and costs over the year and tracks the overall performance of your business. It matches your income and expenses for the period with adjustments made for timing differences. So for example, sales that have been made, but money hasn't been received for yet. And it's important to remember that profit is not the same as cash. We're touching on that in more detail later on. The profit shown in your profit and loss statement includes non-cash expenses such as depreciation. You must ensure that you've got sufficient profit to cover the cash costs such as loan repayments, any asset purchases, and any drawings that you make as director or shareholder. Your profit and loss statement provides a framework to benchmark your results by using percentages or comparisons between years to compare your business performance, perhaps to similar businesses or businesses within your sector. Or it can be used to perform a performance trend over time. Businesses are generally valued using a multiplier of your earnings. So your profit and loss statement is a fundamental driver of the entire value of your business. The higher your earnings are, the higher your value. So I know that possibly goes without saying, the more earnings you've got, the more value you create, but the profit and loss statement can help you to track that. So back to our example. This is the same fictitious food manufacturing company. We've taken the gross surplus from the trading account and now listed all of the expenses, followed at the bottom by the owner's own remuneration or drawings to calculate what is the net surplus or loss. So as you can see, the company is currently trading at a loss of just over 113,000. Now, let's say the company undertakes a review of all their expenses with their accountant and identifies potential savings to be made to their insurance and to their rent. They contact an insurance broker and their landlord and negotiate a 5% reduction, as you can see in that column there, for both expenses. So that means they'll save £597,000 in insurance and just under 3k in their rent. However, you'll notice that their accountancy fees have gone up. Obviously, there is a cost for this. And remember, in the previous example, the company had engaged their accountant for coaching and other services. So despite the increase in these fees, the overall net surplus has increased by 138k, and it's taken them from that loss of 113 to a net surplus of £24,000 as a result of those changes. Let's move across to the balance sheet. This is also known as the statement of financial position, and this provides a snapshot of your business's financial position at a specific point in time. As we talk to our clients, generally people understand and focus more on the profit and loss than they do on the balance sheet. So I really want to draw your attention here to this snapshot of the value of your business and why it's also such an important report. It measures the net worth of your business, which is your assets less your liabilities. It also shows if your business is solvent. If your liabilities are greater than your assets, then the business is insolvent. And obviously you're going to need to take urgent action to fix this. You can compare different periods to determine whether the business's net worth is actually increasing or decreasing. And you can track the strength of the business. The stronger your balance sheet, the easier it will be for your business to survive a downturn. And that how relevant has that become in 2020 for obvious reasons. But it also provides a basis to calculate some of the key ratios, such as debtor days and stock or inventory days. So, okay, let's go back to our Foods Co company. And as you can see, the company is currently insolvent as it has more liabilities than assets. Its working capital is also negative as its current assets there of 138,000 are less than its current liabilities of 162.
Steve, sorry to chip in. Could you either put your microphone up a little bit or move a little bit closer?
Yeah, is that any better?
Yeah, lots better. Thanks, Steve.
Sorry, I'm sorry. Okay, so yeah, I was just saying the current assets at the moment are less than the current liabilities. This means the company is going to struggle to pay its short-term debts from the limited cash or debtors or even the stock it has on hand. Urgent action is going to be required in a company like this to remedy it. The business needs an injection of funds of at least 305k, because that's the net deficit at the bottom of the balance sheet, which may be in the form, this can come in share capital or perhaps even a loan from the shareholder or director. Assuming the company can resolve these urgent insolvency issues, there are other areas for improvement too. So over the long term, the company could implement strategies to reduce their debtor days or stock days to increase their cash flow. So let's have a look at this. To increase your debtor days, you divide the debtors by sales and then multiply by 365. This tells you how long it takes for your customers to pay. It's a really useful calculation for you to know this one. Currently, this company's debtor days are 26. So clearly speaking, on average, it takes one of the customers 26 days to pay an invoice. Now, if they updated their terms of trade and requested payments within 7 days and managed to reduce this by 5 to get it down to actually being 21 on average, then the maths work out such that they would have just short of an extra £14,000 of available cash in the business. Now, how valuable is that going to be to a company in a state as it is at the moment? If we look at inventory or stock days, divide the inventories by cost of sales and then multiply that by 365. It's a similar calculation, and this tells you how long the business holds its inventory before selling it. So in other words, it shows you how long the cash is tied up in that stock holding. And this company currently holds inventory for 74 days. Incidentally, if it's a service company, and that might be a trade, construction or professional service, the calculation I'm talking about here can easily be substituted for what we refer to as work in progress or WIP. It's the same principle. It's how long cash is being held up in the business. So if they reviewed and updated those processes based around stock, and let's say they're able to improve inventory days by 9 days, this would result in a further cash flow boost, and that's coming in at just under £8,000. So together with these two different process changes, we've managed to generate a cash flow gain of nearly £22,000 together. And although that won't, for this company, solve the entire solvency issue, it does demonstrate how much cash can be saved with some input into focusing on these key figures from the balance sheet. Let's have a look at the statement of changes in equity. The statement of changes in equity shows what happens to the profits. They could be paid out as dividends or kept in the business as retained earnings. It represents the net worth or value of the company and is a key indicator of the company's financial health. It also shows, again, whether the company is solvent. So remember, if the company has more liabilities than assets, it's insolvent, and obviously funds are needed to be paid into the company. Let's go back to the example. The company has accumulated losses for at least the last 3 years. This means the company has no retained earnings and is currently insolvent. There's no money to pay out as dividends and no money to reinvest into the company to purchase new assets. Obviously, the directors are going to have to take action now, either to increase the profitability of the business or to inject funds into it to remedy this insolvent position. Let's move on to the shareholder current account. I'm calling it the shareholder current account here, but for most of the businesses that we work with, they're called closed businesses or owner managed businesses, and shareholders and directors are often the same person. So you may be more familiar with the phrase director loan account. It's the same thing. Shareholder loan account or director loan account is the same thing. And it records all the funds introduced to the business by the shareholders or taken out of the business as drawings. It can help you monitor your personal expenditure from the business. And for businesses with more than one shareholder, it maintains obviously the balance between each shareholder and what they've taken or introduced. It shows how much the business owes to each shareholder. The current account is overdrawn. It means the shareholder has taken out more than they've put in and now owes the company money. To put the account back into a positive balance, the shareholder can repay the loan, or the company can increase its profit to pay a shareholder's salary or a dividend that can be declared. But if your shareholder current account is overdrawn, it's important to get advice from your accountant as soon as possible to discuss the best options for you and your business, because there are tax implications for overdrawn loan accounts. Okay, back to our example. So the shareholder current account shows that at the start of the period, the company owed its shareholder, in this case, Mr. Joe, over £29,000. Now, during the year, he's introduced £2,000 of his own money into the company, but he's taken out £9,000, and that's come out through his general drawings and through some life insurance that in this particular case wasn't a company expense. This means that at the end of the period, the company now owes him just under £22,000, and the amount owed by the company to Mr. Doe can only be repaid, obviously, if the company has the solvency and the cash reserves to be able to make those repayments. Because in our example, we are featuring here at the moment on an insolvent company, that's going to be very difficult for him to do. So even though the company owes him money, it's very difficult for him to extract that loan. So to ensure that the company will be able to repay the funds introduced, a profit improvement strategy has clearly got to be implemented here so the company becomes profitable. For example, we demonstrated in the trading account and the P&L earlier on some examples of how we could, introduce processes that can result in an improvement. And in our example, that improvement was a positive 138,000. So it's not sustainable for shareholders to keep introducing money into the business if it's not profitable. Ultimately, it has to come down to trading success, I think, as we all know. Let's have a look at the fixed asset register. The fixed asset register, also known as a depreciation schedule, records a business's fixed assets such as vehicles or plant and equipment, and facilitates the spread of the cost of assets over the useful life. It provides a basis for keeping track of a business's asset and can be a useful guide to determine when assets need to be replaced or they can be budgeted for accordingly. It's also useful when selling a business as it records the current value of all the fixed assets and all the plant within the business. So this first column of the register, the fixed assets register, lists the names of all the fixed assets, with the second column listing the cost of the asset on the purchase date. The next column shows the opening value of the asset at the start of this particular financial period. This is the cost less what's been accumulatively depreciated from any previous periods. And the next two columns show any purchases of new assets or perhaps the disposals of them. A disposal could simply mean that it's reached the end of its life and you're throwing it away. But for depreciation purposes, no longer holds any accounting value. Then we have the depreciation rate and the method of depreciation used. So in this particular example, we're using diminishing value, and that the way that works is it depreciates each asset by a constant percentage each year. Now that's very common for us as accountants to use. There are other methods available. Sometimes we will see a straight line value, which says that there will be the same amount depreciated every year. But generally speaking, we do favour the same percentage every year, which results in what's called a diminishing value. The next column actually shows the depreciation for the period, followed by the closing accumulated depreciation, which is obviously the aggregate total. This is the amount the asset has been depreciated by since it was first purchased. And then finally, the closing value column shows the current value of that asset. So this is the value that will eventually find its way through to the balance sheet. So that sums up 6 of the key reports you should be producing and reviewing regularly. Each report tells a different story about your business and aids your decision making in a different way. So if you've got any questions about any of those reports, if you want to put those into the questions section, obviously we can come back and answer those specifically at the end. So Steve showed you how to submit a question. Feel free and we'll get through to that at the end. In the meantime, we're going to move on to understanding the difference between profit and cash. Okay, so I'm sure you've all heard this phrase here: turnover is vanity, profit is sanity, and cash flow is reality. This fella here on the picture is banging his head against the wall. I'm not sure if that's the business owner or the accountant. I think we'll just leave that that hanging there. It's common for business owners to get frustrated that their bank account doesn't seem to reflect their profits. It's essential that you understand the difference between profit and cash and why a high profit doesn't necessarily result in more cash in your bank account. Now, as accountants with our clients, we're probably having this conversation all the time, certainly on a weekly basis. It is one of those major factors that even experienced business owners still sometimes struggle to see why the cash balance just isn't reflecting the success or the progress that they're getting in their business. And a profitable business can go out of business because it's starved of cash. A business running at a loss can still survive if it still has access to funds, perhaps from investors, or really positive cash flow. So in other words, cash flow is every business's reality. So to demonstrate, let's have a little look about what constitutes the differences between profit and cash. And let's consider some of the factors that create those differences. So first up, VAT. That's a cash item. This is going to affect your cash balance, but it doesn't affect your profit. When we talk about a profit and loss account, all the VAT has been removed from those figures. Those figures are net of VAT when you see them in the profit and loss account. But when it comes to paying your VAT bill, you still have to make a cash purchase, a cash expense every quarter. So it's very much a cash item. Loan repayments, which one are they? Again, they are cash items. When you repay a loan, it's not part of your profit. It's not a deduction of profit, but you still need to find the cash in your bank account to make that loan repayment. What about the interest on the loan though? The element of that repayment, that is the interest charged by the finance company. Which column does that go in? I hope you guess right, it goes in both. Interest very much is a cost to the business. It does reduce the profit for any interest you pay on loans. And of course, it's added to the loan repayment to be paid back to the funding company. So it's both a profit and a cash transaction. What about when we go out and purchase assets? So if you go and purchase a piece of machinery, which column does that one go into? Yeah, it's just cash. The assets, as we saw before, in terms of fixed assets, go on to the fixed assets register and they find their way to the balance sheet. It's the depreciation that ends up in profit. And of course, in terms of cash, just linger on the asset for a while. If we buy something through HP or some other form of funding, clearly there are means of being able to spread that cash implication when buying assets. What about when we sell an asset? It's the same thing. It's just the flip side of an asset purchase. Depreciation, I've kind of already given the answer away to this. Depreciation is how we drip feed the cost of fixed assets into the P&L. So it is just a profit and loss transaction. You don't actually pay out for any depreciation. You've already paid it on the asset purchase in the first place. So as you can see, if your business achieved a healthy profit, there still may not be enough cash in the bank after paying, you know, the tax, making loan repayments, and any new purchases of assets that you still need to make. And this is the big differences that lie behind the profit and cash, which sometimes eludes a lot of business owners. Let's have a look at the Business 101 cycle. First, the owners need to invest money into their business. This money can then be used to purchase the assets needed to run the business. The business may need additional funding to buy all the assets they need. It might not all be generated from the business owners themselves, so they may take on a loan or HP, etc., to finance that purchase. These assets, the reason we buy them is they are then used to generate a profit, and you can increase your profit by growing your sales or margins. But likewise, your profit can be drained, if these costs are not managed. The whole point of a profit is that we then want to turn that into cash. So drains on our cash can include when our debtors pay us too slowly, when we hold stock for too long, the loan repayments we've talked about, VAT payments, etc., etc. But a business can achieve its cash gains by collecting the debtors in faster, reducing the amount of time stock or work in progress is held up, perhaps even negotiating longer payment terms with suppliers, and doing whatever they can legitimately to reduce tax. And to complete the circle, the intention is that the owners then take the cash out of the business as drawings or repayments on their personal loans. The remaining cash can then be reinvested into the business and perhaps to buy more assets to generate more income. But the key here, the whole point of the Business 101 cycle and everything that goes into it, is that our aim is to push or cycle cash as quickly round this, because the quicker you go around this cycle, the faster return on investment you get as a business owner. It's a really useful diagram that to see, what is effectively what you're doing in your business from day one. So after cash flow, business value is the next most important measure of a business's success. Part of knowing your numbers is understanding and measuring the drivers of your business value. These drivers might be your monthly recurring revenue, or your revenue growth, or your revenue per client, or your profit itself. Now, these are going to be different for every business, but we can work with you to identify the drivers of your own business value. And we often refer to these as KPIs, key performance indicators. To enhance the value of your business, you must first develop and implement a clear plan, document your organization structure and roles within your business. So if we can establish cloud-based real-time reporting, this will allow you to make better decisions, and reviewing and documenting your systems and processes ensures your business is running hopefully as efficiently as possible. Reducing the reliance on the owners of the business helps enhance the value. One day, if the business is sold, it is able to separate itself from that owner. And again, that will enhance the value. And finally, identifying and managing risks means that these can be mitigated before they become an issue. So as we've seen throughout this webinar already, the profitability, cash flow, and the value of your business all affect you personally. If your business isn't profitable and doesn't have much cash available, you're not going to be able to pay yourself and fund whatever lifestyle it is that you desire. There are a few other things you can do to help protect your assets. So I'm going to run through those now and just go through them one at a time. So first of all, set up your business as a company to limit your personal liability. This is, as we all know, incorporating a company, limited liability. Number two, consider who should be a director of your company and which assets are held personally by those directors. Ensure that you have security over any money you lend to others. Consider alternative ownership structures for high value assets. So an example here is if your business owns the commercial premises that you use, consider moving the ownership of that to a separate limited company, or it can even sometimes be done into a pension fund. Review your terms of trade and credit policies to ensure you only provide credit to customers who are likely to pay you. Review your insurances, make sure you have sufficient protection. For example, have you got business interruption insurance? Have you got indemnity insurance and enough cover to ensure the impact of your business of any of adverse events is going to be as minimal as possible? Ensure you undertake financial planning. Now, this is very much a personal thing about your own personal wealth and can be done with independent financial advisors. And finally, plan for the future. Do you have an up-to-date will? Do you have a power of attorney in place? So many of us don't, but we do need that clear personal plan about transferring our assets to the next generation one day. And look, there's 8 points there. It's not an exhaustive list. These are just some of the ways you can protect both your business assets and your personal assets as well. We can help you identify specific ways you can help protect your own assets. So, how does everything I've talked about today come together as best practice? So, I think it's summarized as follows. Every business should use 3 essential tools. It should have its annual business plan. And again, this year we've been talking to a lot of people about business continuity plans, business recovery plans, business appraisal plans. You may think they're different titles for the same thing, but this has been a very strange year and these are still strange times, and we try to plan in accordance with those in slightly different ways. Accompanying that should be your annual forecast to give you tangible targets to aim for. And then both of these, as you'll have heard us say time and time again, both of them need ongoing reporting and accountability. The reporting ensures the numbers you want to achieve in your plan and forecast are being measured, and the accountability process is in a form of coaching. And you need an independent coach to hold you accountable to getting this plan achieved. So knowing your numbers is just the beginning, as it allows you to improve them and ultimately achieve your own goals for you, for your business and for yourself. So what next steps do we have? Where do you go from here in these challenging times? So our aim is to help you take what you've learned today and implement some positive change in your own business. Now it's time for you to decide what you're actually going to do about it. Take a few minutes after this webinar to write down 3 actions or projects that you will add to your business. What problems are you experiencing in your business? Identify these problems and use them not just as a problem, but as an opportunity to create that project in which you're going to go about fixing them. Doing nothing right now should not even be an option that you're thinking about. Now, when we finish the webinar, you will be taken directly to a survey screen, and I'm asking you in that survey to jot down, make yourself accountable right from now. From now on, make yourself accountable. Tell us what your 3 plans are. We're more than happy to then meet up with you and talk through those and see whether you've got a sustainable plan and the position you're in. Start to think, give yourself three plans, 3 projects, 3 targets today. So now you know what you should be doing as part of best practice in your business. How perhaps can we help you? Well, if you don't currently have a business plan or a business recovery plan, then we can help you develop one. We can also help you create management reports. Now we do this all the time. We can do it on a monthly basis, quarterly, whatever it seems to be. And obviously as part of that, we can catch up with you and review those numbers with you. And that review includes discussing potential areas for improvement along the lines of what we've been seeing in our example company. And finally, we can offer you complimentary 1-hour meeting, as I've just suggested a few minutes ago. Let's have a look at the different packages we offer them. To wrap this all into one, so to go through with you with an annual plan, a forecast to accompany it, and then meeting with you to keep you accountable to that plan. We're already doing it with lots of clients, and we charge £285 a month for that. If you want to slightly vary from that, from a one-to-one basis, and enter into our business club, it's slightly cheaper. You get, obviously you don't get the one-to-one attention, but you do get the peer group, the idea of being in a peer group that who can network with each other. Now, getting that business group started in a physical sense has obviously been hindered by the COVID process, but as soon as we're allowed to, that's back on track, and we'll be welcoming clients to take huge advantage from that. We can, if you already have your business club, your business plan, we can let you into the business club for a very reasonable amount of £100 a month. I'm not going to go into infinite details of what this is involved, but again, in the survey straight after the webinar, if you've got questions on that, then let us know, and we can contact you directly. Management reporting depends which company you are and how often they are, but again, that sort of service can start from around £150 a month. And then if you want to talk to us about any of this and how you might be able to implement this in your business, we don't charge for that. You can arrange a meeting. Steve, I, or one of our other team members will be more than happy to spend the time with you and go through. But look, we know it may be difficult to commit to spending money right now, and all of these services include an assessment as to how you can improve your profitability and cash flow. So there's also opportunity for great return on investment from this period over time. For the short term, we've got different payment plans available as well. So please don't let that be a barrier. We want to make ourselves available to work with you. We already have a lot of clients doing this at the moment, and there's all kinds of success stories that we've managed to play a role in helping them develop. So it's fantastic to be in being involved in that. But look, the information in this educational webinar today is general in nature, and it's not a substitute for us giving you specific tailored advice and support. So, you know, our aim is still to work with you one-on-one, and we'll be able to identify the most important actions to take that's going to hopefully give you the biggest impact for positive results in your business. So that's the content through. I'm going to invite Steve to come back in now. Steve's been taking a look if there's been any questions throughout. Have we had any questions, Steve?
Yes, we have, Steve. First from Alison, what's the difference between annual accounts and accounts that can be produced throughout the year, which we'd actually call those management accounts, Alison? So the big difference is that annual accounts are historical. In other words, you know, we're looking back at what's happened over the previous year. We're making our accounting adjustments, like, you know, the tax and depreciation and stuff like that, prepayments and accruals. Whereas with management accounts, really we're giving you up-to-date data, which of course it's going on throughout the year, and therefore, you know, you've got a much better picture of business performance, and you can use that for planning. So I hope that explains that. Robert, what's the difference between markup and margin? Good question. Yeah, so we spoke about gross margin, and is that the same as the markup I put on my prices? And, you know, if I'd had a tenner for every time that I've been asked that question, I'd be doing okay. So in terms of percentages, markup and margin are just not the same thing. So if, for example, you buy an item of stock for 75 quid and sell it for £100, then you've marked your cost up by £25, which is basically 33% of your original cost. So that's markup. Margin is different. Margin is basically the difference between your selling price and your cost price. So in this example, your selling price is £100, your cost price is £75, and therefore you've got £25 profit, and £25 profit is on £100 is 25%. So although the values are the same, in other words, £25, the percentages are different, and we have to be really careful what we mean when we're looking at margin. It's not markup. Margin is the important one, if you want, because confusing the two is just going to basically, we're going to end up with two different sale prices. Yeah, very important one. Thanks for that, Robert. Alex, if there was one financial indicator to keep your eye on, what do you think that would be? For me, it has to be gross profit. So if you think about it, so if you target an operating profit, in other words, operating profit's basically your net profit before tax and dividends. So it's after all your costs, but it's before tax and dividends. And we all know basically how much we want to, we want that figure to be, hopefully. So if we target that, and then if we add your fixed costs to that, your rents and your rates and your phone and motoring costs and stuff like that, and if you combine the two, the target operating profit and the fixed costs, you're going to end up with a target gross profit, and that is the key number. Gross profit covers all your costs, and what's left is basically your operating profit. So you've got to have the right gross profit to get the right net profit, in other words. And the way I look at it, so all businesses have an activity that contributes directly to your gross profit. So for example, a firm of solicitors, the number of hours that they've got to sell, that's basically what they have to sell is time. Whereas in a restaurant, the big contributors to gross profit would be the number of covers they do. So that's measurable. So if you set your target gross profit and look at the activity contribution, covers or hours or what have you, to that target on a regular basis, and then you can find ways to improve it. That could be, for example, pricing, which is personally one of my favorites. It could be upselling. So in other words, in a restaurant, that could be, would you like a coffee after your meal or something like that? Or it could be a direct cost reduction. In other words, the restaurant may be able to find suppliers who do them a better deal on their, on their food purchases. It's a very simple indicator, GP. And it's easy enough to measure on a regular basis, but it's exceptionally powerful. So hope that helps, Alex. Okay, Chris, can you elaborate on the tax implications for directors' loan accounts? Yeah. Oh, sorry, overdrawn directors' loan accounts. Yes, Chris. So basically, if you've taken more money out of the company through your director's loan account than you should have done, and there's an overdrawn balance at the end of the year, then basically the taxman wants what's called Section 455 tax off you, which is basically, it's a holding tax, which is payable by the company, and it's actually payable at quite a high rate to really discourage people from taking more money out of the company than they should be doing, and that rate's 32.5%. So the rule is that if there is an overdrawn director's loan account at the end of the company's accounting year, and it's not cleared within 9 months of that date, then the company's got to pay that Section 455 tax. However, the good news is that it's actually repayable. HMRC will repay that tax once the overdrawn loan account balance has been cleared, and that's paid 9 months after the end of the accounting period, if you like, where when the loan is cleared. Could take 2 years to be cleared, or it could be cleared in the next year. And that's not just directors, obviously, that's shareholders. Steve mentioned shareholders' loan accounts, directors' loan accounts. They're basically the same thing, so that applies to everybody. As I say, it is a high rate of tax because basically HMRC want to deter people from doing this. The only other thing to say, Chris, is that if the overdrawn director's loan account is more than £10,000 at the end of the financial year, then basically it's going to be treated as a benefit in kind to the director. They've got an interest-free loan, and that would be taxed as a benefit on your P11D, unless the company is charging you interest and you're paying that interest over. Okay, I think that just about does it for questions. Lorna, yes, we're going to have a presentation. Sorry, are you able to forward the presentation of the webinar, please? Yeah, we're recording it, so we'll make the presentation available to you, Lorna. Brian, is there a course to teach business owners how to effectively run off various reports from Xero? Is there a course?
Steve, can I answer this one? Can I jump in here? Because
sure, please do.
I think that's a great idea. I think, more often than not, every day we're training one client or another. Usually somebody who's new to it, we train them on Xero, we get them started. I think if I go back long enough in my memory, Brian, you'll recall when we trained you on Xero. What you're talking about there is perhaps more of an advanced course, which centres on reporting. And do you know what? It's something we have thought about, perhaps having more of an online delivery where clients can come together and we'll show not just reporting, but tips and tricks and all the sort of things that we've learned with Xero over the years. It's a very good idea. Can you leave us with that one? Because I reckon, Steve, if we have a chat about this, it's probably not a bad thing for us to do, to invite clients along and get a little bit of collaboration over Xero. Because we've just spent an hour talking about how important it is to monitor your numbers. So why not give you some education on exactly how you can do that? Be a good idea.
Excellent, thanks, Steve. That's all the questions I have. Unless anybody else has got any late ones they want to ask.
I've just checked the chat bar, Steve, and I can't see any more coming through.
Yeah.
I guess just to re-emphasize to Lorna as well, yeah, that you'll find that on our YouTube channel. So if you go to YouTube and just search on BWP Inspire, all our webinars go there. So yeah, if you've missed any of this today or you want somebody else to watch it, Lorna, you can find it there. Just it'll take us a few hours to format the video and get it up, but later on it will be available for you. So in terms of drawing to a close, then there's a couple of things. As I've said a couple of times, there is an exit survey. Please give us feedback, because we want to be delivering value to you in where we can. So we want to try and ensure we're hitting the right key, but also it's an option for you to tell us if you do want to have a meeting with us, or if you're interested in any of the surveys. But also you may recall when you registered on the webinar that aside from this, we've prepared a report as well, a guide. So you've got some paperwork to stay with you, which might be a little bit of a memory aid going forward about what some of the factors we've talked about today are. So again, on that survey, if you want a copy of our guide to financial reporting, just drop it on there and we'll send that across by email to you straight away. So I hope you've enjoyed today's webinar. I think it's obvious now, although we've never really said it, but I think we've pretty much adopted a monthly routine now. So we'll be looking to announce quite soon what our November webinar is going to be, and we look forward to seeing you then. I'm just hesitating. I think questions come in just as I was talking to there. Chris has asked, how do we register for client area on the BWP website, please? Yeah, that's our client portal. We've just been in the process of changing it over, Chris, and it's all about how we can exchange our documents safely and securely under GDPR. So as a client, when we have documents to send to you, we will introduce you to that, and I'll make sure somebody reaches out to you as a result of this today to show you how you can join it yourself. So I hope that answers your question. Thank you, everybody. Thanks, Steve. Thanks for your time this morning. I hope that's been of great value, and we'll see you soon.
Yeah, thanks everybody. See you soon. Bye.